Good morning, everyone, and welcome to our first webinar of 2023. Today, we are with our President and CEO here at Elevate Wealth Advisory, Deanne Rosso. And Deanne joined our firm back when it was Vickery Financial in 2005, and then she assumed full ownership in 2018. Deanne is a very proud University of Georgia graduate. And today we're going to go over all the different changes through the financial data that may have been updated from 2022 to 2023. And that will cover HSA limits, required minimum distributions, and many other financial data. So welcome, Deanne.
Thanks, Betsy. I'm glad to be here with you today. So, hey, everybody, it's good to be here. Happy New Year to all of you. I'm excited to be here to share with you guys information on key financial data updates for 2023. And as most of you know, limits change, the laws change, we get certain increases on certain numbers and certain things we can do every year. So every year, this time of year is a little bit of a playing a game of catch up. What's new for the year, particularly when it comes to things like retirement plan contribution limits and different limits for different types of plans, and taxes. What's changed in the tax landscape? And for 2023, we definitely have some news to share. As many of you probably know, back in December, Congress passed legislation that has been dubbed Secure Act 2.0. And in a future webinar, we're going to present some more detailed information on Secure Act 2.0. But for today, I'll touch on it a little bit as I go through some of the key financial data updates for 2023. So I'm going to start by sharing my screen with you guys. And I'm going to share with you what we call key financial data card for 2023. So those of you who may know me or who may be my clients or who may meet with me, this will look very familiar. I use this handy reference card almost every single day in doing planning for clients. It is one of my go-to references. And sometimes I'm like, I get the question, why are we focusing so much on these numbers? Don't you guys do investments? Like, should we be focusing on what type of investments we're doing and the performance and those kinds of things? And that's absolutely true. We should. But, at Elevate Wealth, one thing that we know is we have a better chance at being successful in our overall plan if we control the factors we can control. And unfortunately, the market is not one of those factors. So what are some of the things we can control? We can control costs, we can control risk, and to an extent, we can control taxes. So today, a lot of the things that I'm going to be sharing with you are in regards to these data updates for taxes for 2023, because sometimes they can make a really big difference to your overall long-term success when we pay attention year over year to some of the tax numbers and the strategies that you can use to help minimize your taxes. So I'm going to start with this key financial data card, and I'm going to zoom in as I go to different sections that I'm going to highlight. So first section I want to highlight is right in the middle, and I believe that we have this card available to email after this presentation. So if you guys want a reference, if you want to have a copy to reference on your own afterwards, we can get this out to you. But right here in the middle of the card, first item I want to hit today is standard deductions. So what is standard deduction? The standard deduction is the money that the government just allows you to earn without paying any tax on it. That's a very simple definition for a standard deduction. So back in 2017, the Tax Cuts and Jobs Act was passed, and that started in 2018 with a new tax schedule, and the whole act was designed to make tax prep simpler. So how do we make tax return prep simpler? And one of the ways that the Tax Cuts and Jobs Act did that was to almost double the standard deduction. And it did away with a lot of the things that were miscellaneous deductions that we used to itemize. So when you do your tax return, you have a choice every year. You can either take the standard deduction or you can itemize. And for most people, If you have a mortgage, you can deduct your mortgage interest. If you pay state and local taxes, you can deduct those, but those are capped up to $10,000. And charitable gifts. And those are what I call the big three in itemized deductions: state and local taxes, mortgage interest, and charitable deductions. And if those three things together for you are less than the standard deduction amount for the year and whatever tax filing status you're in, you're just going to take the standard deduction. And in a way, that's what simplified the tax code with the Tax Cuts and Jobs Act. Is it made it so that more people take the standard deduction rather than having to keep up with things that they itemize. So for this year, in a married filing jointly for the standard deduction, it's $27,700. That is up from last year's $25,900. It's almost a 7% increase in the standard deduction. And a lot of these numbers, a lot of these increases that we're seeing here are tied to inflation. So obviously, with 2022 being a year where we saw a lot of inflation, we've seen some pretty significant increases in these numbers, and the standard deduction being one of them. So if you are married filing jointly, that means that the first $27,700 that you make in income is not taxed at all. Also, if you are blind or over age 65, we work with a lot of retired clients, so this applies to them in some cases. Each individual gets an additional $1,500. So single or married filing separately, you get the $13,850 plus $1,500. If you're married filing jointly, you get $27,700 plus $3,000, $1,500 for each individual. So that for a married couple means $30,000 that you can take in income without really having to pay any tax on it. So that's what I wanted to talk about with standard deduction, and how does that apply to your taxable income. So now I'm going to move over to the left-hand side of the card, and what we're going to talk about here is the 2023 tax rate schedule. So there is a 0% tax bracket, and that is the standard deduction. But when we talk about taxable income, what we're talking about is the income that you earn minus the standard deduction. So it's essentially anything that's starting with $1 over your standard deduction. And we have a progressive tax system in the United States, which means that not every dollar is taxed the same. So this is what we call the marginal tax rate schedule. And I'm looking mostly here at single and at married filing jointly, which is where most filers file. And we also got a bump in the brackets this year. So as an example, in the 10% marginal tax bracket for a single individual, it goes from $0 to $11,000, and that's up from $10,275 last year. And then the next bracket, which is 12%, caps at $44,725, which is up over $41,725 last year. So these brackets also got somewhere between a 6 and a 7% bump in the amount of income that you can make and stay within that marginal tax rate. For married filing jointly, we're looking at an increase to $22,000 in our 10% bracket and up to $89,450 in our 12. And that again is up from about $83,000 last year. So it's somewhere in between the 6 and 7% range of an increase in income that you can take at those levels. So a married filing jointly couple, using them as an example, and let's just say you're over 65 for rounding out the numbers, you've got $30,000 that just really doesn't count right off the bat, which means a married filing jointly couple over 65 can make $52,000 and only pay essentially $2,200 in tax, because you only pay 10% on that first $22,000 over and above your standard deduction. So it's just important, I think, to know kind of how your tax is calculated. And when we talk about the marginal tax rate, we're talking about the tax rate that you pay on the last dollar earned. So, for example, if you made let's call it $100,000, and you fall into the 22% bracket, then at $100,001, that $1 is taxed at the federal level at 22%, whereas all the dollars below it are taxed at 10 or 12%. And That's where we get into what we call the effective tax rate. So for each individual family, your effective tax rate is essentially the average. What's the total amount that you owe in tax divided by your taxable income? And that's essentially what your effective tax rate is. And that's a better estimate for how much tax you pay on each dollar that you bring in. Okay. So tax rate schedules, standard deduction, definitely something to pay attention to every year. And, it's interesting how many folks I ask, how much did you owe in tax last year? And if someone asked you that question right now, would you know how much you paid in tax? Or would you know what your refund was or how much you owed? And for most of us, we know if we got a refund or we know if we ended up owing tax, but we really don't know how much we actually paid in tax or what our marginal or our effective tax rate is. So some data like this can just help you take a look at your tax return and figure out, which marginal tax rate you're in, how much did you take the standard or the itemized deduction? And there are some strategies you can use around that. So for example, let's say that you're close to maybe with your charitable giving and your mortgage interest and your state and local taxes, you are close to the standard deduction amount, but not quite over, which means you would take the standard deduction. But what if in a given year, instead of making charitable gifts annually, what if you bunch them up? So what if you take 2 or 3 years of charitable gifts and you bunch those into 1 year, just so you can get to the level of itemizing and get a bigger tax deduction for that? And then in years 2 and 3, you just take the standard deduction. And there are some different types of accounts and strategies we can use for that. But paying attention to how close you are to either standard deduction or itemizing can help make sure that you get the most tax benefit out of things like charitable gifts. Okay, another question that I get a lot of the time is, what are tax rates on long-term capital gains and qualified dividends? So particularly when we're thinking about how we save for retirement and then how we turn that retirement income into, or how we return those retirement savings into retirement income, a lot of the times we're thinking about different sources of income that we can use to be most tax efficient. And long-term capital gains and qualified dividends are a great example of this. So if your taxable income, married filing jointly, is $89,250 or below, then you pay no tax on long-term capital gains and qualified dividends. So that can be a nice strategy to try and keep your income lower from qualified sources like IRAs, 401ks, et cetera, in order to take some capital gains and qualified dividends and pay no tax. But even if you make in the next tier up, so as a joint family over $89,250 or as a single filer over $44,625, you get a preferential tax treatment on long-term capital gains and qualified dividends. So you're only paying 15% as opposed to your ordinary tax rate schedule, which may be around the 22% tax bracket. So we often say that tax rates and on capital gains and qualified dividends they get preferential treatment. And it's a nice strategy to save over time in an account type that gives you capital gains and qualified dividends, to be able to have that asset to pull from later on at better tax rates than ordinary. And then worst case scenario, if you're a high income earner and your income is over 492,000 single or 553 joint, you still only pay 20% tax on capital gains and qualified dividends, even when your tax rate may be in the 35 or the 37% range. So paying attention to how you're saving in retirement, or how you're saving for retirement, or how you're just saving in general, and then how you take that retirement income stream in retirement can really make a big difference when it comes to the tax rate you're paying on every dollar. And I'll talk a little bit more about that later. All right, moving on to the right-hand side of this card, a question that I get a lot is, how much can I give away in a year without having to file a gift tax return? And the answer to that lies here in this box: gift and estate tax exclusions and credits. So Every year, any individual person can give to any other individual person $17,000 without triggering the need to file a gift tax return. And what that means is I'm often asked if there are any tax advantages to making these gifts. And it doesn't mean that you get to deduct that on your tax return. It doesn't mean that the recipient gets any better tax treatment necessarily. It's just a way that you can remove assets from your estate and give them on perhaps to the next generation or friends, family, whatnot, without having to file anything. Or without having to include it in your estate. So every year you can give $17,000 per individual. So that doubles. If you're a couple, each of you can give $17,000, to a child or a grandchild, and to any other individual. But the only real benefit to doing that is to remove assets from your estate so that you don't have to claim those as part of your estate. And also you don't have to file a gift tax return if you keep it under less than 17,000. But it's not a big deal if you give more than 17,000. All you have to do is file a gift tax return. And the reason that that's important is our estate tax exclusion right now is really high. It's $12,920,000 per person. And what that means is that's how much you can leave in your estate without paying federal estate tax. So all it means if you give more than 17,000 to an individual in a year, when you anything over 17,000, you would file that gift tax return, and that's going to go against the $12 million you have to leave later on. So that's the deal with gift and estate tax exclusions and credits. And again, a question that I get a lot, but something we can certainly help you with if you have further questions about that. Okay. All right. So on the front of the card also, one thing I always like to know, we have lots of other information that I'm not going to go into much detail about today, things like education credits, deductions, distributions, all of those things if you're in the stage of life where you have kids in college or you're preparing for college for children. All of these limits are listed here on this card, and you can take a look at that if those apply to you. Tax deadlines. This one applies to almost all of us. So we always think of April 15th as our tax day, and that certainly is in the law. It is April 15th, or if that April 15th happens to fall on a holiday or on a weekend, a lot of times the IRS gives us a couple extra days, which is the case this year. So this year, tax day is April 18th. That's our tax filing deadline, or the deadline that we have to request an extension. And October 16th would be the deadline for those extensions. If you pay estimated taxes, January 17th is when your fourth installment was due. That's today. So your fourth installment of estimated taxes is due today if you haven't paid those. And then you have your quarterly installments listed here, June 15th, September 15th, as your quarterly, April 18th also. I missed that one. So January 17th, April 18th, June 15th, and September 15th as your installments of estimated taxes. And then into January for 2024 for that last installment of your 2023 estimated taxes. Lots of things happen on December 31st. Last day to pay expenses for itemized deductions. So if you are going to itemize for the year, all of that has to be completed by December 31st. Establish and fund a solo 401k or certain types of retirement plans. Those need to be not necessarily funded, but established by the end of a year to comply for that year. And then correct excess contributions to IRAs and qualified plans. So if at any time during the year you have made contributions, let's say to a Roth IRA, that one, a Roth IRA typically has income limits associated with it. And a lot of times if you're on that edge of the income limit, and I'm going to show you that in just a minute, you won't necessarily know if your income is going to go above that amount until you get mid-December, when you think, okay, particularly for self-employed individuals, my income is going to be above the limit this year. So the IRS gives you some time. By the end of the year, you're supposed to remove those contributions that you made during that year if you're going to be over the limit for that year. And December 31st is the deadline for that. Okay, So that's the front side of the card. Lots of information, lots of numbers, lots of things that don't apply to everybody, but I think lots of good information that can help us determine our tax rate. Do we take the standard or the itemized deduction? About giving gifts, what about capital gains and dividends, things like that, and our tax deadlines. I'm going to move now to page 2. So the back side of this card, and we will start with the left-hand side of this card. Oh, accidentally went to page 1. Okay, here we go. Retirement plan contribution limits. So like most of the numbers we looked at on the front side, retirement plan contribution limits also got inflation adjusted increases this year. So what I find that typically applies to most individuals is how much can I put in my 401k in a year? And you can see that number here, 401k, 403b, 457, Roth 401k. This year, there's an increase up to $22,500 in salary deferral that you can add to your 401k or 403b or Roth 401k. And if you're over age 50, also an increase, you get up to $7,500 that you can add as a catch up. So the IRS, a lot of times when I see families who are in what I'll call the sandwich generation. So, you are working in some of your higher earnings years, you are raising a family, you have children that are maybe in high school or going into college, a really expensive time in life, at the same time as maybe you have aging parents that you're helping take care of. And there's just so many things to think about in your lives. But at a certain point, typically for individuals age 50 and over, the kids graduate college, and caring for parents becomes easier. And so then you're also at your peak earning years normally during those same years. And the IRS has been so gracious as to say, you know what, we know you missed out on some savings opportunities over those years when maybe cash was a little bit more strapped than it is now. So we're going to give you guys a chance to catch up and add a little bit more in salary deferral to your 401k or your 403b or retirement plan in order to help you catch up and save a little bit more for retirement in those higher earnings years. And the best part about that is you also can get tax deferral on that. If you do a pre-tax contribution, you get to defer more in perhaps a time when your income tax rate is higher. So just kind of kick the can down the road on those taxes. Or maybe you're at a point where your income is too high to contribute to Roth IRAs. So you can put more money in your Roth 401k and save in a Roth bucket if you're not able to in your own Roth IRA. So increased limits this year for 401k salary deferrals and catch up. Individual retirement accounts. So another question I get a lot of the time is how much can I put in my IRA? And what are those income limits? So this year, the limit has gone up to $6,500 that you can put in a traditional pre-tax IRA. The catch-up stayed the same at $1,000. So if you're over age 50, that's a total of $7,500 that you can put in a traditional IRA. And there are some stipulations to that. If you're covered by a retirement plan, then you actually have a lower income limit to be able to contribute to a traditional IRA. But if you don't have a retirement plan at work, there is no income limit. So that is a really nice benefit for those who may not have access to a retirement plan at work, that you can put $7,500 in a traditional IRA to help yourself save for retirement. And if one spouse is covered by a plan, but the other spouse is not, you do get a higher income limit in order to help that other spouse be able to put into an IRA or save for their retirement. And actually, both of you can do it if one spouse is covered by a plan, but your income is less than the max of $228,000. Okay. Roth IRA, same limit, $6,500 for 2023 with $1,000 catch up if you're over age 50. The income limits here are the phase out starts at $218,000 and goes up to $228,000 joint, or $138,000 to $153,000 single. So this is just a really important thing to pay attention to. We always encourage folks to get as much into Roth IRAs as possible, but sometimes that income limit becomes a challenge, particularly for those of you in your higher earnings years. Then we can consider strategies you may have heard of, like a backdoor Roth. Which is where we actually fund a traditional non-deductible IRA. And that's back up here at the top of this box, traditional non-deductible. Anyone can put $6,500 or up to $7,500 over 50 into an IRA. The income limit determines whether or not it's deductible. So you could put $7,500 if you're over age 50 in an IRA if your income is higher and just not deduct it. And then you could consider the strategy of converting those funds, no income limit on Roth conversions, into the Roth. And that's a way that higher income earners can sometimes, with other caveats met, following the rules, that's sometimes a way that higher income earners are able to save by doing Roth conversions. Okay. So when we talk about the traditional and the Roth IRA, you can do $6,500 in one or in the other, but not in both. And you could combine them. So you could do half in the traditional and half in the Roth, but $6,500 is your total limit between the two different types of accounts. We like IRAs for the tax deductibility. We like Roth IRAs for the fact that they grow tax deferred and are tax-free in retirement. I'm actually going to touch on that again at the end of this presentation. But one account that we really, really like that not necessarily everyone has access to, but it's a health savings account. And if you have access to a health savings account, this is the most tax efficient type of account that you can own. And it's because your contributions into a health savings account go in pre-tax. And when you pull that money out to spend it on healthcare expenses, there's also no tax for withdrawals when they're done for healthcare expenses. So it becomes a completely tax-free account, which is one notch above a Roth IRA. And you may be thinking, well, okay, that's great, but how's a health savings account going to help me in retirement? Well, let's just say, well, first of all, in order to have a health savings account, you have to be in a health insurance plan that is high deductible and eligible for an HSA. And then you put part of your salary typically, or you make contributions into it. And we have maximums here, just like with a Roth. So families can put up to $7,750 in it. Individuals, $3,850. There's also a catch up for over age 55 of $1,000 a year. So what if you spend a few years, if you have access to a health savings account, saving in the health savings account, putting in the max at pre-tax dollars, but you don't necessarily need to spend that money for out-of-pocket expenses, and you just let it accrue. And a lot of times health savings accounts, sometimes they'll have a provision for different types of investments on the inside, whether it's just money market or interest-bearing accounts or up to some aggressive investments, and you can actually let those dollars grow. When you get to Medicare age, you're no longer eligible to put into a health savings account, because if you're on Medicare, you're not eligible for a health savings account. But then you can start spending that money on things that are out of pocket, copays and such, that Medicare doesn't necessarily cover. Now, Medicare covers a lot, so I don't want to scare anyone into thinking it doesn't. My clients that have gotten on Medicare are very happy typically with their Medicare coverage, but there are still some things. Think about glasses, think about contact lenses, think about dental work. There are still certain things that Medicare doesn't cover. And if you have a health savings account that's grown over time, where you can pull funds out of that to use in retirement, instead of pulling funds out of an IRA that's fully taxable to use for those expenses, that can be a really, really nice tax savings. So if you have the option of saving in a health savings account, I always recommend it. These are your limits for 2023. A lot of times people also don't know that your long-term care premiums, if you pay for long-term care insurance, are deductible at certain ages. So this is what that schedule looks like. If you qualify for deducting your long-term care premiums, they qualify as a medical expense though. So one thing to know here is Whatever amount you're able to deduct in your age category, you would add that to whatever other medical expenses that you have for the year. And then in order for them to be an itemized deduction, that amount has to exceed 10% of your taxable or your adjusted gross income, I believe. So a lot of times that just erodes any potential tax benefit. But if you do itemize your deductions and you have medical expenses that you tend to deduct, and you have long-term care insurance that you pay premiums for, just know that you can add in that amount at whatever your age is to deduct as a medical expense. Also, cool information for those of you who are on Medicare or who are approaching Medicare age, your Medicare deductibles are listed here on this card as well for your reference. All right, shifting now to the middle of this card. Got just a few more bullet points to hit today. Social Security. And one thing that I always like to share with everyone about Social Security is that the tax that you pay on your Social Security dollars depends completely on how much income you make elsewhere, plus half of your Social Security. So it's something called provisional income. And you can see that little asterisk here. And what is provisional income? Provisional income is your adjusted gross income, not including Social Security, plus tax-exempt interest, plus 50% of your Social Security benefit. So when you add up those numbers, then you come to what is your marginal bracket effectively on your Social Security benefit. For most people, if you're married filing jointly and you make more than $44,000 in provisional income, then up to 85% of your benefit is taxable. And if you're single, then over 34,000 of your provisional and make over 34,000 in provisional income, up to 85% is taxable. But it is a bracketed system. So you do get a tax break on your Social Security. And in the state of Georgia, Social Security isn't taxed. So that's also a nice benefit. And that is dependent on which state you live in as to whether or not Social Security is taxed. Okay. I'm going to skip over now to, I keep going to the wrong screen. Sorry about that. Okay, Medicare premiums. So one important thing that I always like to share is your Medicare premium is also dependent on your modified adjusted gross income. And it's not this year's modified adjusted gross income. It's the modified adjusted gross income from 2 years ago. So for example, 2021 modified adjusted gross income for singles of 97,000 or less or joint of 194,000 or less, your Part B premium for this year will be $164.90 a month. So just as a refresher, Part A is free. Part B is a standardized premium, which is on this schedule. Part D, your drug plan, is here on this part of the chart. That's also a standardized premium. And then whether you go with a traditional Medicare or Medicare Advantage will determine what you pay in premiums for the rest of your Medicare coverage. But your Part B premium increases based on your modified adjusted gross income. And it's from 2 years ago. And the reason that I like to highlight this is because sometimes things happen in our lives that give us a bump in income in 1 year. And then 2 years later, we've already forgotten about that. But all of a sudden we get a statement in the mail that our Social Security benefit for next year is going to go down. And I've had so many clients who've come to me or who have emailed or called me and said, why is my Social Security amount going down for next year? And when you look at the statement, it's not that the Social Security benefit's going down. It's that the Medicare premium increased based on something that happened in their income 2 years ago. So if you ever have things as a retiree who's on Medicare that happen, like maybe you sold a piece of property and it generated a capital gain that was taxable to you and that increased your modified adjusted income for the year, then that means that 2 years from then, if that bumped you into a different Medicare premium bracket, you're going to pay that higher premium. Now, there are certain exceptions to this. There are certain life events where you can fill out a form, submit that to the Social Security Administration, and they will review it and they will reduce your premium back to what it should be based on current income. Retirement is one of those things I can think of that is a reason for an adjustment. And this is called IRMA. It's called Income Related Medicare Adjustment. And so when you do the IRMA adjustment form, if you retired and your income changed because you retired, it dropped down because you're not making maybe what you were making in your highest earning year before retirement, then you can submit the IRMA adjustment form for consideration, and the administration will then decide whether or not you can bump your premium back down for that year. But the exceptions to that are really few and far between. And doing something like selling an investment property and generating a gain that happens to increase your income is not an exception. So it's just an important point to note and to plan for. When we know that, there are certain things we can do, like I'll use as an example, if you give charitably, maybe this is a year where you have some type of income event with a capital gain. Maybe that's a year where you consider doing bunching up those charitable gifts, like I talked about on the front side of the card, so that you get a larger deduction in one year that may help offset some of the gain that you got from the sale of the property, and maybe that will bring your income down to a level where it will also impact your Medicare premiums. So there are certain strategies like that that you can consider if you do a little bit of planning. Again, you've got kind of 2 years to think about it, but most of the time people forget about it, and then they're just caught off guard when their Medicare premium went up. Good news is it only goes up for a year. So after that year, if your income comes back down to what its normal level is, you go back down on the chart to whatever your normal Part B premium should be. All right, last thing I want to cover on this card today is the Uniform Lifetime Table, which probably means that the name of that chart probably means not a whole lot to all of you, but it should. If you have IRAs or 401ks or 403bs that will someday be subject to required minimum distributions. The Uniform Lifetime Table is the chart, the life expectancy chart, that's used to calculate your required minimum distributions. The really important thing to note in 2023 about required minimum distributions is the change that occurred because of Secure Act 2.0. So if you'll recall, a couple of years ago with Secure Act, Secure Act 1.0, it increased the required minimum distribution age from 70 and a half to 72. Well, Secure Act 2.0 has extended that again to age 73. So 2023 is a year where no one new will start required minimum distributions. Because if you turned age 72 last year, you started required minimum distributions. But if you turn age 72 this year, you don't start required minimum distributions. And if you turn 73 this year, you already turned 72 last year. So you already started. So there will be no one new taking a new required minimum distribution this year based on their own IRA. But next year, if you turn age 73, that's when you will start your required minimum distribution. And there were also some edits to the life expectancy numbers, which we use to calculate the required distribution. And for your information, the way that that's done is you take your year-end balance of your IRA, and then you find your age that you'll be in the current year. So you would take your 12/31/2022 balance. But if you turn 74, let's say in 2023, you would use the age 74, and you'd divide that year-end balance by your life expectancy factor, which is 25.5. And that is your required distribution for 2023. One thing that didn't change in Secure Act 1.0 or 2.0 is the age in which you can make qualified charitable distributions. And what the QCD is when you take what your RMD, your required distribution, would be, or part of it, and you don't have to do all of it, and you give it directly to charity, and you're able to do that without taxes. That's the only way that you can really remove IRA assets without paying any taxes. And you can do that starting at age 70 and a half still. So that age didn't change. So to think about that from a planning mindset, what we can do is we can start thinking about what your charitable, if you're charitable again, we can start thinking about what that charitable giving strategy looks like, from retirement on. Do you want to bunch up deductions in certain years to be able to itemize and then take the standard? And then once you hit age 70 and a half, you can start giving qualified charitable deductions from your IRA to draw down that balance a little bit before you get into required minimum distributions, because required minimum distributions are just that, they are required. So if you have pension income, or if you're working part-time, or you have Social Security and you have other sources of retirement income and you don't need your required distribution, it doesn't matter. You still have to take it out and pay tax on it, which can push your bracket into a higher level than you really need for income. And that's really why, to summarize, all this information is important. Sometimes people ask me, like, why do you put such a focus on taxes? Why are you talking about taxes all the time, Deanne? And the reason I'm talking about taxes all the time is because they're really important when you build a retirement income strategy. It's one of the most important things. And it's not just important in retirement. If you can get ahead of that and you can plan in your pre-retirement years and then in your early retirement years, it just makes things so much easier from a tax standpoint later on. You can control your tax brackets a little bit more effectively when you have some flexibility over it. To illustrate that, I'm going to flip over to a different slide. Let's see, get to it really quick. I'll show you guys, again, those of you who know me, meet with me, you've seen this before. This is what we affectionately call the tax buckets. Still have our old company logo on that. Have to get that changed. I didn't notice that when I pulled it up earlier today. But we've been using it for a long time, obviously. And the reason that we use this tool is to illustrate the fact that when you save in different types of accounts, it really is all about tax. The tax flexibility that you can have later on. So we always recommend to people who are pre-retirees and you're saving for your retirement, let's try to save in all three buckets. But the more that we can maximize savings in this after tax, this Roth bucket, and in this tax advantage bucket, particularly when your income is lower and you're not in your peak earning years, all those funds can grow and be available to you later on in life, when you can pull those out at minimal or no taxes at all, and then leave room for your higher earning years to defer funds into taxes to bring your overall income taxes down in those peak years. And then I'll always say that the greatest tax flexibility you really have is from the day that you retire until the day you start Social Security. And required distributions. And those two don't go hand in hand, but the strategy in those early retirement years is really important, because that's the time when we consider things like, how do we bunch your charitable gifts? How do we do Roth conversions if that's appropriate? And how do we maybe even pay a little more tax in the pre-retirement years to pay less tax later? So it's all about staging the approach. And the sooner we can begin working with someone to save in these ways and to maximize their savings capability in the different types of accounts, the better opportunity we're even going to have later when we're working with them to design a retirement income strategy. So I've given you a lot of food for thought today, I hope. I know I've done a lot of talking and a lot of looking at numbers, and your head may be spinning a bit. But I think it just really highlights the things that we are looking to do when we work with our clients each day, is to take stock of, what types of income you have, what are the tax opportunities you have, and how can we really help you effectively stage things in order to focus on the things you can control. And taxes, to an extent, is one of those things. So Betsy, does anyone have questions today or any thoughts you'd like to add?
We do have a few questions, and I wanted to invite everybody. There's a chat box at the bottom of your screen, as well as a Q&A box. So if you have a question for Deanne, feel free to put that right in there. But one question is regarding claiming charitable donations and mortgage interest. Just as an example, did I understand that if I normally take the standard deduction, can I, in essence, take several years of unclaimed donations and interest and claim it in a single year?
You can only claim the items that you actually had in that year. So you can't go backwards, and you can't claim, let's say that you gave charitably for 5 years in a row. You can't go backwards and claim gifts that you gave over the last 5 years, all in this current year or all last year. It would need to be an approach where maybe it's more of a forward thinking approach. So maybe you say, I know that I typically give X amount of dollars every year. So what if I go ahead now and set aside some of my assets in something like a donor advised fund, at using that as an example, and take all 5 years worth of gifts and claim that gift in this year. And there's certain ways you have to do that. But you can do that. And then for the next 4 years, you don't claim any gifts. So you would claim the dollar amount that you actually gave in this year. And when you do a strategy like giving to a donor advised fund, and I won't go into the depths of what a donor advised fund is today, but we'll have some more education on that probably in March when we do tax planning. But when you give to a donor advised fund, you deduct the gift into that fund all in the current year. But then over the next few years, what you would do is dole out the funds from that donor advised fund to the charities that you care about. So that's kind of how that strategy works. But you can't go backwards. You have to think, in this year, I want to make 5 years worth of gifts now, and couple that with whatever mortgage interest you paid in this year and whatever state and local taxes you paid in this year.
Okay, that makes sense. Another question is, what's the benefit of making estimated tax payments if the IRS is not requiring those payments?
That's a great question. And the simple answer to that is so that you don't get hit with underpayment of taxes, an underpayment penalty. So way back, I don't know years, but way back when the tax code first started, there was no estimated tax schedule. It was just, in fact, I think September, I think, was a tax deadline at one point, and then they moved it to March, and before they finally settled on April 15th as being the day. But way back then, it was just, that's when your tax was due, and you paid it by that date, and that was it. But then somewhere along history, and I'm blanking on all the details, but the government decided, or the IRS decided, hey, instead of like getting all of our money at one time, basically in arrears, let's require people to pay us on a regular basis. And that's essentially what the law is now. So if you don't have taxes withheld from your paycheck, because taxes that are withheld from your paycheck are paid on a regular basis, so that meets the law. Taxes that are withheld from your retirement account distributions or your pension payments or whatever, those are regular estimated tax payments that you just don't have to make. But if you don't have regular estimated tax payment, if you don't have regular taxes withheld from your income, then the government expects you to make a payment every quarter as an estimated tax payment. And if you don't, then you'll be subject to underpayment penalties. So that's the advantage, is to avoid underpayment penalties, and then just to meet essentially the letter of the law as to what your withholding schedule is supposed to be.
Okay, wonderful. If anyone has any follow-up questions, feel free to email them. You can reach me with Betsy at marketing at elevate-wealth.com. And then before we go, I wanted to share my screen real quick. Let's see. We will be using one of our favorite books, which is the 27 Principles Every Investor Should Know, and talking about this all year long on our new WealthWise video series. So we established this series last year on our YouTube channel. And if you want to tune into that or subscribe to our YouTube channel to watch the videos we're producing this year, you can go to youtube.com and search for Elevate Wealth Advisory in Athens, Georgia. And here you'll also be able to see this webinar later today. If you want to share it with any friends or family, you'll be able to see all of our WealthWise videos we did last year. And then I also wanted to invite you to go to our website, which is elevate-wealth.com. And you can go to the drop-down menu and go to attend webinars. Well, you'll see the whole list of webinars we have for the whole upcoming year here. So those will all be in there. We're going to be covering investments. We're going to be covering tax planning that Deanne mentioned in March. So be sure to go there. You can register right here on our website for any of those, or you can look at our Facebook page. So look for Elevate Wealth Advisory, click on the events tab, and you can see all of our webinars there as well. Again, if you have any questions at all for Deanne, just feel free to email those to me. And we'll look forward to seeing you next month when we cover investing. Thanks so much, Deanne.
Thank you.
Bye, everybody. Have a good day.
Bye-bye.